Understanding how a bond's duration and modified duration respond to changes in market variables is essential for investors managing interest rate risk. Duration measures the weighted average time to receive a bond's cash flows, while modified duration adjusts the measure based on changes in yield, indicating a bond's price sensitivity to interest rate. This section explores how duration and modified duration are affected by four key factors: changes in coupon rate, increases in bond maturity, fluctuations in market-wide interest rates, and variations in the bond's current market price. Each of these factors alters the timing and value of cash flows, influencing the bond's interest rate risk profile. Through explanation and numerical examples, we'll illustrate how these relationships work in practice and how they can impact investment decisions, especially during volatile or uncertain economic periods. Coupon rate is the fixed interest rate a bond pays to its holder, which is shown as a percentage of the bond's face value. When the coupon rate increases, assuming that maturity and price stay constant, both duration and modified duration tend to decrease. This is because higher coupon payments provide more cash flows early in the bond's life, which means a greater proportion of the bond's present value is received sooner. Duration measures the weighted average to receive cash flow. With more value coming earlier, the time-weighted average shifts towards the present. As a result, the bond becomes less sensitive to interest rates changes because the investor gets more money back sooner, reducing exposure to fluctuations in the market interest rate. Modified duration, which adjusts duration for current yield, also declines in this case. So as you can see in example 1, coupon rate 2%, price $1,000, maturity is 10 years, the duration is 8.79 years, and modified duration is 8.37 years. In example 2, coupon rate is 4% and price and maturity stay the same. The duration decreases from 8.79 years to 8.38 years, and same with the modified duration, going from 8.37 to 7.98 years. And we see that continues for duration going from 8.38 to 7.95 to 7.52 to 7.1, and modified duration going from 8.37 to 7.98 to 7.56 to 7.14. Maturity is the length of time until a bond face value is repaid in full to the bondholder. As maturity of a bond increases while keeping the coupon rate and yield constant, both duration and modified duration will generally increase. This is because the longer the time until a bond matures, the longer investors must wait to receive final principal repayment. Even if coupon payments stay the same, pushing that lump sum further into the future increases the weighted average time to receive cash flows, which is what duration measures. A longer maturity also means that the bond is more exposed to interest rate risk over time, since there's more time for rates to change and affects the bond's value. Therefore, long maturity bonds are more sensitive to interest rate changes, and this sensitivity is captured in increasing modified duration. So as we can see in example 1, maturity is 3 years, coupon rate is 5%, price is $1,000. Duration is 2.81 years, and modified duration is 2.73 years. As maturity increases and coupon rates and price stay the same, duration increases and modified duration also increases. And we see that for the rest of the examples, as the duration increases up to 15.7 and modified duration increases 12.84 years. Now we're looking at the fixed duration, modified duration as the market-wide interest rate increases. The market-wide interest rate or market rate interest rate of yield to maturity is best rate of return demanded by investors for bonds with similar risk, maturity, and credit quality. When the market rate increases, the price of a fixed coupon bond falls, but the effect on the duration, modified duration, is more significant. Modified duration will generally decrease because it's calculated as Macaulay duration divided by 1 plus R, and the denominator gets larger as the interest rate increases. Durations might stay relatively stable or even increase slightly, depending on how heavily the later cash flows are discounted. However, the main message is that as rates rise, the bond's price drops and becomes less sensitive in percentage terms to further rate changes, which is what modified duration reflects. So although you're still exposed to interest rate risk, the impact of each additional rate increases on the bond's price is relatively smaller. And as we can see in example 1, interest rate is 2%, coupon 5%, maturity 10 years, the price decreases, duration decreases, modified. And the price is 1211, duration 7.98 years, and modified duration is 7.82 years. In example 2, the interest rate increases, and then the price decreases, and the duration and modified duration increase. And we see for the following examples, the duration keeps on increasing, going from 7.98 in example 1, when interest rate is 2% and 10%, and the interest rate is 10%, goes to 8.55 years for duration. And same for modified. But for modified duration, it goes from 7.82 to 7.83 to 7.85 to 7.82 to 7.77. Now a fixed duration modified duration as the bond price increases. Bond price is the current market value of a bond, the amount an investor would pay to buy the bond today. When the bond price increases, typically due to a fall in market interest rates, both duration and modified duration increase. A higher bond means a lower yield to maturity, which reduces the discounting effects of the future cash flows. As a result, those future payments, especially the final principal repayment, will hold more weight in the calculation of time weighted average cash flow, for example, duration increases. Since modified duration adjusts for interest rate, a lower year to maturity increases its value as well. Therefore, premium bonds, which are those trading above par value, tend to show higher interest rate sensitivity than bonds trading at a par value or discount, and this was reflected in the rising duration figures. As we can see in example 1, the price is $900, and the coupon rate is 6% and maturity is 10 years. The duration is 7.56, and the modified duration is 7.03. In 2, the price increases to $950, coupon rate and maturity stay the same. The year to maturity decreases, but the duration and modified duration go from 7.56 to 7.71, which is an increase, and 7.03 years to 7.21, which is also an increase. As we see, when the price goes from $900 to $1,100, it goes from 7.56 years to 8.43 years, and modified duration goes from 7.03 years to 8.08 years.
Macroeconomics and business cycle analysis. NBER's recession dating methodology. The National Bureau of Economic Research, or NBER for short, defines a recession as a significant decline in economic activity across the economy, which tends to last longer than a few months. NBER, unlike relying solely on the common rule of 2 consecutive quarters of negative GDP growth, uses a broader range of indicators. These can include real personal income, non-farm payroll employment, real consumer spending, industrial production, and real GDP. This multi-indicator approach allows for a more accurate but results in a delayed recognition of recessions, which means it ensures comprehensive economic validation before reporting economic turning points. This can be both a positive and a negative. So we have next the longest expansion and contraction in US history. The longest US economic expansion occurred from July 2009 to February 2020. This span was obviously quite a while. It was due to the global financial crisis and the aftermath of that, which was marked by lowered interest rates and steady employment growth. However, it wasn't large, it was just steadily increasing, and just overall expansion as the globe recovered. The longest contraction occurred during the Great Depression from August 1929 to March 1933, which is a 43-month lasting period. It was caused by a collapse of asset values, unemployment increasing, and overall banking failures. These two scenarios reflect the differences in economic stability, policy change response, and financial system design upgrades across the different eras, announcement lag, and investor implications. So we've got a table here. We've got a table here. It just has the starts and the ends of, and the peaks and troughs of those recessions and contractions. So we've got the we picked three. So we got the COVID-19 recession, the global financial crisis recovery, and the dot-com crash end. So the announcement from NBER of the COVID-19 recession was June 2020. It was September 2010 for the global financial crisis, and it was July 2003 for the dot-com crash. The turning point of these recessions were for COVID-19. It was February 2020, global financial crisis, June 2009, which is the trough, and then the dot-com crash in November 2001 was also the trough. The lag from NBER was for the COVID-19 4 months, so which means it was just announced 4 months after it happened for COVID-19. It was 15 months for the global financial crisis, and it was more than 20 months for the dot-com crash, which is quite a while. Due to the nature of NBER, there is often a delay between the actual economic turning point and the official announcement from NBER. What this means for investors is that the delay implies that real-time decisions cannot rely solely on NBER data alone. By the time a recession is declared, markets usually or may have already adapted or even started recovering in some instances. Therefore, investors must use different indicators such as yield curves, consumer confidence, and industrial production trends. The limit of diversification. So how is portfolio diversification achieved? Portfolio diversification is achieved by allocating investments across a wide variety of assets and securities. The goal of that is just to reduce overall risk, as there would be a wide portfolio of investments. The rationale is that all asset prices do not move in sync. Different markets are going to move separately. This means that by holding assets with low or even negative correlations, an investor can reduce the overall volatility of the stock portfolio without sacrificing expected returns. Diversification is usually implemented by investing in different industries, sectors, and even different geographs. So it could be, different states or different countries. It's also implemented by combining asset classes and holding a mix of stocks like growth stocks, defensive stocks, and cyclical stocks. According to the modern portfolio theory, or MPT for short, the most optimal portfolio is one that maximizes return for a certain risk level, which is usually achieved through effective diversification. What are the constraints of international diversification? So international diversification can be limited by some constraints, as most. So some of these can be currency risk. So for example, foreign exchange rates can fluctuate, and this can affect potential returns quite significantly. The market integration. So in globalized markets, foreign stocks can be correlated with domestic ones during a crisis, reducing the diversification of the stock. And then we also have the regulatory and information barriers. So investors may face difficulties in assessing reliable data, understanding foreign market laws, or complying with local legislation, since it could be all different in an overseas country compared to the domestic market that the investor is usually based in. The political and economic instability. So in some regions, there can be political and economic instability, and this can increase the overall risk of investing internationally because there's no real way to tell what could happen. What is the limitation of diversification during a market-wide crisis? So during a market-wide or worldwide crisis, such as the global financial crisis or the COVID-19 crisis, correlations among asset returns increase significantly. This phenomenon is known as the correlation breakdown, which is when stocks that are typically uncorrelated or negatively correlated move in the same direction due to a wide variety of factors, which can include like consumer panic selling. This usually results in benefits of diversification decreasing. Evenly diversified portfolios, they usually experience significant losses, and then systematic risk dominated and no stock asset class is safe unless it is correlated with global financial systems. This is usually materials like cash or gold, something that's value doesn't really change. So next we have the empirical illustration of diversification limitations. So an intro to this is, the aim of this section was to examine whether diversification effectively reduced portfolio risk during the global financial crisis and during COVID-19, which we did this by using historical return data from a major stock market index, which is we used the S&P 500 index, and then we selected two other stocks. We used Apple Incorporated and JP Morgan Chase and Company. So the S&P 500 is a broad representation of the overall US market, and Apple is a part of the technology sector, as we may know, and then JP Morgan is a part of the financial sector. So for data collection, we used Excel to record and accurately calculate the data. So we got the data from Yahoo Finance. The main formulas we used were having to calculate the monthly average increases, and then getting the standard deviation. So the formulas for the average is pretty simple. New month minus old month over old month. And then the deviation, we just use a standard Excel formula. And then we have two files with the data. We have one for the COVID and one for the global recession. So as you see here, we've got the tables. You can see that in the peak years, which is 2008 for the global financial crisis and 2020 for COVID, although the stock volatility of all stocks through those times, they all had an increase. Through the global recession, they're still quite separated, but for the COVID-19, they were quite similar lines. So according to the modern portfolio theory, diversifying across assets with low correlation will reduce risk. However, during a crisis, this isn't usually correct. So for example, correlations between stocks increase significantly, which is shown by our volatility graphs for both crises. Both stocks become similar throughout the years of effect. This is known as, as mentioned before, which is known as correlation breakdown. Investors exhibit behavior called herding, which means they sell assets to increase liquid assets. Liquid assets are like cash. Since there is a crisis, there is usually a market-wide panic, which overrides the industry-specific panic, which leads to widespread volatility, which is again shown in our graphs. Going back to the graphs, we've got some numbers. For all of the times before 2008, for the global financial crisis, the S&P went from about 12% to 24% volatility. So it actually really doubled in how volatile it was. Apple didn't really change too much. So it went from 58 to 60, and then JP Morgan went from 19 to 56%. So that's quite a large jump there. And then for COVID-19, so for the S&P 500, it jumped from 12 to 26%. For Apple, it jumped from 24% to 38%, and for JP Morgan, it jumped from 22 to 40. So overall, it's about the same kind of jump in both crises. Therefore, the systematic risk dominates, and diversification provides little to no protection. The real-world evidence shows that portfolio risk cannot be eliminated, which is amplified in times of extreme market stress, like in a crisis. To conclude, really, the Analysis of Apple and JP Morgan, along with the S&P 500 during the most recent two major market crises, revealed that diversification fails to shield investors from losses when systematic risk surged. Portfolio managers had to recognize the limitations of diverse stocks and consider alternative risk management strategies like hedging or investing in defensive assets. This section highlights that whilst diverse stocks reduce firm-specific risk in normal market periods, it is not a secure substitute for a crisis-resistant portfolio.